Ladies and gentlemen, welcome to the Unnamed Podcast with the great and powerful Brad Freeman, the stock market nerd, and the amazing Evan, stock market news. How you guys doing?
I'm doing pretty well. It's exciting tomorrow with Taiwan Semiconductor, or really late tonight, I guess. Tomorrow, late tonight, however you want to say it, and on Netflix tomorrow afternoon. But we've got some big bank earnings that have already reported, so we can talk about credit data if you guys want to, or whatever you want. I'm game.
I'm excited as well. This should be a good one. The market's been moving. Nvidia has been flying. Shout out to that one. We got Jensen in China, so I imagine there might be some more headlines. There was even some good videos coming out that I thought was interesting. I really thought that Peter Thiel was going to pump my BMNR bags today, but that went a little bit of the other way. I know we have that Coinbase event going on right now, so I don't know what they're going to end up announcing. We're kind of watching a little bit in the background here.
Yeah.
But yeah, there's a lot of people coming in. I'm excited for this chat, and yeah, it should be a good one. What about you? What are you excited about, Tanner?
I'm keeping an eye on this Coinbase thing just in the side here. But honestly, it's been an unbelievable time for Nvidia. Not that on a percentage basis, it's blowing me away compared to other positions like SBET or something like this that's flying, but still being a name that I very much enjoy. Hitting all-time highs is a ton of fun. SoFi doing not all-time highs, but hitting highs that we haven't seen in a very long time. That's been continuously fun, and there's been a lot of green days since the last time that we've spoken. So we are in the full bull market right now. Holy, that was hard to get out. But that's actually one of the things that I wanted to talk to you guys about, because I am notoriously a terrible seller of stocks. I like to buy them, I like to hold them, and I never really know when to exit them. And Brad, I've been following you for a little bit. I think that you're better at trimming your positions and actually taking advantage of potentially high multiples and rotating out sometimes. So I really wanted to talk about that this week as well.
Yeah, sounds fun. What do you want to start with, Evan?
I mean, I feel like you kind of were talking there. Was there a lead in that way? For me, selling is super difficult as well. That is an area that I am horrible on. I've also been dipping my toe in the trades, and goddamn, I have no idea what I'm doing in that area too. So I honestly, I don't think it's that hard to go in and pick great companies. I think it's difficult to stay with them when it maybe doesn't look good. It's hard to take the profits. We spend a lot of time talking about what great stocks are to buy, but there's just so much more to it that we don't always talk about it. Position sizing, portfolio management, but also selling is a big part of it. I'm working on it.
I think it's crazy sometimes, like whenever you hear that, like it's easy to buy good companies, but I secretly do. I don't know if I'll say it too many times out loud, but I actually do agree with you that finding the quality names is not too hard. They're just most of the time very expensive as well. If you hold them long enough, they seem to work out in the end. But the good stuff usually does flow to the top, which makes markets at sometimes easy. But if you're trying to find companies that are underpriced and those are the best names, that's where it gets extremely difficult, I guess.
Yeah, and buying the best names isn't going to get you to 75Xs. It probably isn't going to get you into those Palantirs and Robinhoods. It's probably going to get you into the Nvidias, the Microsofts, the Googles, the beautiful Apple. But when we're talking the scale of 10Xs, it's very different than the scale of consistently beating the market over time.
Yeah.
So I don't know. I think that it's probably very difficult to go in and find those 10X opportunities. And that's where a lot of people go in and find. But finding great companies is not the hard part in this game.
Yeah, I think it's important to split sell decisions by exit decisions and lighten up or trim a little bit decisions, because I think in terms of exiting, it's a matter of, these companies owe us consistent execution, and they owe shareholders earning our time and our attention, our money. And if that's not happening, with fundamental mistakes, it's important to kind of, I guess, not forgive, but be a tad patient when there's a blunder or a misstep, and that's the anomaly in a sea of executing extremely well and performing really well, and not just cutting ties based on kind of a one strike you're out policy. But if there are just consistent excuses coming quarter after quarter, explaining why things aren't looking good, saying macro sucks for us, but inexplicably it's not so bad for our direct competitor, where things should be similar for them in terms of how the exogenous backdrop is supporting or not supporting their business. I think as the norm becomes a new excuse to explain why there's more disappointment, that's when you exit. And I think exiting as a choice or as a decision is a lot easier, at least for me, than trimming, just because I talk about it a lot on social media and with readers. We don't owe these companies any loyalty, and I think sometimes people get somewhat dogmatic with loving companies and unconditionally embracing them and being, for lack of a better term, kind of a cult about it almost. And I think it's extremely important for our love for these companies to always be conditional, to always be based on what have you done for me lately and what do I expect you to do for me in the future. Because I guarantee you none of these CEOs know my name, know a lot of people's names, or know the names of whoever.
That was him saying, yeah, they might know my name.
No, it wasn't me saying that. It was me saying that they don't care. Well, if they know my name, they don't care about me, and they don't care how my bank account is growing or how my finances are taken care of. So I think it's important to be emotional or emotionless and to really kind of avoid that loyal, unconditional stick with them through thick and thin mentality, to ensure that we are sticking with them because they deserve that they deserve our time and our money and our attention, which is finite, and it needs to be allocated accordingly. So, exiting, I think exiting is easier, but trimming is a bit of, I can stop there before we talk about trimming and see if you guys want to interject anything. But for me, that's kind of how I think about exiting. It's always fundamental performance or lack thereof.
And yeah, I don't know if you did touch on it, but the only one I would add is if there's potential other opportunity that's just amazing as well, that maybe you need to rotate out of one position in a similar sector to get into another one.
I think for me, that's if there's no cash sitting there, if there's no cash availability, because I think still if something I still think has the risk reward and a solid probability of outperforming my benchmark over a holding period, even if I think there's something else that will outperform it by more, I do think diversification to a certain degree is important for people, and I know a lot of other people would disagree with me. Stanley Druckenmiller would say that's dumb and you should have a few high conviction holdings, and other people would say something along the lines of what I'm saying. But yeah.
What is the sweet spot there? Because I used to be a holder of like 30 names, and then I was listening to Bill Ackman say that he had ran a study in his firm that said there's no impacts for diversification past 14 names. So that's exactly what I lowered down to, was my top 14 highest conviction names. So how do you look at diversification to a certain extent?
Yeah, I think it is kind of more of an art than a science, and it is based on personality and risk tolerance and disposable income and anxiety and all these really, I guess, hard to quantify things that make up who we are as people. But for me personally, I've always kind of I went from like 8 or 9, and at some point I was above 30, and it's been over the last several years, I've noticed kind of a range of 18 to 20 names that the portfolio has been made up of. And for me, that kind of is a byproduct of rules that I have, where I'm allocating a certain amount of money for unprofitable companies and a certain amount for profitable, and letting them run from there. But even then, they're not going to, and we'll get into trimming and talking about trimming in a second, but with the approach that I have, there's really not going to be anything that grows past 10-15% of holdings. And I know this is completely different from you, Tanner, and that's totally fine. It's just stylistic and based on what works for us, and there's no one size fits all. But for me, that 18 to 20 range has really been something that allows me to focus enough on my best ideas while having that comfortable level of diversification. So one move for one name is not completely blowing up or making or breaking my portfolio.
Yeah. By the way, for the most part, I never ever really let a position get past 30%. I haven't done that in a very long time. Only recently did I break that rule. And even now, if you look at my tweets, I've kind of been talking about rotating back, because it is scary to have half of your portfolio in one name. It is that's a lot of concentration. But
I took a look at all of Ackman's filings since 2007 on a website. he has never held more than 13 stocks. So that's fair enough.
That would make sense then, eh?
Yeah, sometimes they say things and don't stick to it, but at least he's staying a rule and you can see it actually happening. But never had more than 13.
Especially for Bill Ackman, you got to be careful with what he says and then what he does. I mean, but I guess in that case it does work. But he seemingly has some well-placed statements that also somehow interject with some long play that he has or short play, something like this that coincided with some TV appearance that he's had recently.
He's a little dramatic sometimes.
Is this a Nike one?
There's just a bunch.
Yeah.
I could probably not off the top of my head, but I could probably find like 5 or 6 instances where he has played the opposite or has taken advantage of his appearances on television.
Yeah. Should we change the subject to trimming versus exiting, or
please?
Because I think that has way more to do with this idea of valuation, and then again, valuation is an art, not a science. There's no perfect metric for any company. There's nuance for every single business model that makes some metrics worse or work extremely well sometimes and make them irrelevant other times. Free cash flow for you SoFi lovers is a great example of that, of how it's just such an important metric for an enterprise software company or an infrastructure company, but like a digital infrastructure company. But for someone like SoFi, it's just irrelevant because it's a byproduct of how many loans did I just add to my balance sheet or how many loans did I sell. And that basically is how free cash flow is powered for that company. So again, just different valuation metrics for different companies. We can't get into how to treat each different company based on metrics, but just part of the annoying nuance of fundamental analysis, and part of the reason why it takes people a little while just to get familiar with the just granular details of evaluating a company. But for me, I really gravitate towards and love Peter Lynch's PEG ratio framework. So price to earnings ratio divided by earnings growth. And for me personally, earnings or that profit metric is where I'm either using net income or EBIT, which is a proxy for operating income, earnings before interest and tax, or free cash flow. And ideally using at least one growth multiple from the cash flow statement and one growth multiple from the income statement. So if there are things like stock comp add backs or mark-to-market equity gains and losses that are throwing off one financial statement and not the other, that makes it super apparent and makes it obvious. But extremely overgeneralized rule of thumb for Peter Lynch, and within that framework is 1x or 1.0 times PEG is that threshold of expensive or cheap. But for me, I think it has a lot more to do with how reliable and how visible and how high certainty that growth is. For a company like Apple, you're going to probably pay a higher growth multiple for 5% earnings growth than you are for another company supposedly growing 5% that you know nothing about, that doesn't have a several decade long track record of delivering for shareholders. So just the probability of that profit growth coming in and being as expected can oftentimes lead to maybe a company that's not delivering that much earnings growth getting a 2x or a 3x or a 4x PEG ratio. Think of companies like Walmart, Apple, Costco, Visa, just these blue chip brands that aren't really growing profit very much, but we know there's a much higher chance of them being around and succeeding and growing in 10 years than another company that's unproven. So just something to keep in mind. But for me, it's funny because these companies, they often trade in valuation bands and in growth multiple bands. They go higher, lower, and it's within a pretty well-defined range. And so what I'm doing is, as these companies are approaching the high end of that range, I'm lightening up. And I'm not saying I'm selling 90 or 95% of a position. I'm selling 5, 10, 15% of a position. And if it just continues expanding from there and continues getting more expensive, which for me inherently means lower risk reward and less compelling investment case, I'm just continuing to ease up and ease up and ease up. But there are times where, and I can drop a name from the portfolio in this, a company like CrowdStrike, where I have been in that lightening up phase for, it feels like, a few years, because it just seems like that's had a valuation premium to everything else for a very long time, and rightfully so. I mean, what they're doing in terms of cross-selling a full suite in cybersecurity, and the revenue quality they're delivering and the kind of growth and the kind of margin and all the things that I love as a fundamental analyst deserve that kind of premium. But at some point, things get more and more expensive and you kind of lighten up. And that's been happening again for me, for CrowdStrike, for a few years. But there are these generational companies. There are these once in 100-year enterprises that just are delivering the kind of fundamental quality and opportunity and ability to take advantage of that opportunity that's so coveted and special and unique. And CrowdStrike, I think, is a great example of that, where I will trim and trim and trim until it gets down to a part of my portfolio where it feels like if I trim anymore, I don't really have any skin in the game. And at that point, I'm trying too hard with market timing and feels like I'm almost exiting and timing up a re-entry, where I will kind of plug my nose and own shares of a company that I know is ahead of itself, that I know is too expensive, that I know shouldn't have this kind of valuation multiple, because I'm not really willing to fully part ways with it, because I don't have confidence that it's going to get down to that bargain level price that I want to start entertaining accumulating. So for me, it's just it's almost the embodiment of that greedy when others are fearful and fearful when others are greedy. It's just using that in my own way and tweaking that in my own way and in an approach that's worked for me, and really in a way that takes the decision making and thought and contemplation out of when do I sell or when do I trim. It's waiting for a company like for CrowdStrike, when it gets down to a 2.5x peg, yeah, I'm going to start adding. When it gets up to a 3x peg, yes, I'm going to start trimming again. It makes it more robotic and rules based for me, which is also helpful. But I think expensive is okay. Valuation premiums are often earned, but at some point things get to a place where future expectations of future returns kind of are just not compelling. And even if you love the company, even if you have nothing but good things to say about everything that they're doing, it does make sense, in my opinion, to occasionally trim. And I do catch a lot of flack for that from people, from never sell investors who think that I'm timing markets and trading, and you can call it whatever you want. To me, it is still a long-term investing approach and more of an active approach within that realm. But yeah, that's what works for me. I think that was like 6 or 7 minutes. So hopefully that was coherent and made sense.
It's 20 or so minutes, but that's okay. We'll run the clock back. No, I actually was truly just listening in like I was a viewer of the podcast, because I am, whenever you think about the greedy when others are fearful, I think I'm pretty good at that. The fearful when others are greedy, not so good at that. I find myself just sitting back and enjoying the ride along with everyone else. And
I just get FOMO in both directions, you know?
Yeah. I can buy dips, but I never I'm starting to see things in markets. I mean, every single stock that I'm getting recommended is under what seems like a $5 billion market cap. And everything that everyone wants me to buy is these trash. Well, I don't want to say trash, but just pre-revenue, just concepts almost. And that always scares me, because not too long ago, I was getting recommended Google and Amazon and Nvidia and all of these names that everyone knows that are solid businesses that I find are getting talked about less and less.
Yeah, there are signs of, there are a lot of signs of euphoric, animalistic excitement right now in markets, which I think it's definitely not comfortable. But then you juxtapose that with the idea that the Fed's probably going to cut rates a couple of times this year and cut its. And I mean, when the current administration gets who they want as Fed chair, hopefully in 2026, hopefully not before Powell's term is over, but we don't need to talk about that. It's probably going to be an extremely dovish Fed chair who's going to deliver a lot of rate cuts.
Yeah.
And as long as that doesn't lead to just a massive acceleration in inflation, it should be pretty bullish for risk assets and for liquidity and all the things that drive multiple expansion for these companies. So it's this
I
weird,
just had a conversation with Devin Ryan, and he was even talking about stable coins as being a way for global investors to get more online, and that they are not going to want to buy just their own country's assets. They're going to want to get a part of the United States assets as well. And so if you raise the amount of the population, these are not new concepts, but just to reiterate, if you raise the percentage of the population that is investing, that are buying the same, S&P 500 companies, that will raise multiples. And is that sort of thinking as like this time is different, or is there something real to this? Like, do we deserve higher multiples? is the PEG ratio going to need to get readdressed? Is 1.1 times the new middle,
It kind of already is. I mean, I do these valuation comp tables that I share with readers, and averages are consistently 1.5, 1.6x, somewhere in there. So that and I mean, other things that Peter Lynch talked about was a PE ratio under 20x, and things like that. So I think that the world has definitely changed, and that probably has a lot to do with the fact that we've printed a lot of money over the last couple decades, and the Fed balance sheet has just grown in size gigantically. And I don't know. I do.
You think that affects multiples?
Say that one more time.
Do you think that affects multiples as well?
Oh yeah, for sure.
Wouldn't that affect earnings?
The amount of money that's available. Well, it would impact multiples for the same reason that you're talking about, like stable coins in international countries where people don't generally have access to U.S. assets. It'll create more supply or more demand for those equities, and more demand chasing the exact same amount of supply. Prices will just go up.
One thing I would say is I feel like naturally, like if you believe AI, it's going to drive companies to be more profitable. Margins are going to be higher. A higher percentage of everyday people are investing. More countries are getting access to the U.S. market. I don't see forces here that would cause these multiples to go down. It feels like we are going in a direction where, maybe it's less companies, and also the pace of innovation has continuously increased. So maybe it's less companies getting that larger multiple, but I don't see how we're going anything away from except for that direction,
Yeah, as long as during the earnings seasons they actually do show off the productivity gains that people are expecting.
Yeah.
I think once that starts to drop off, that's what happened in the .com bubble, right? It's not that people just went, the internet's a fad. It just wasn't as fast as the multiples were.
Some of the valuations on these AI companies are getting wild. XAI talked about raising $200 billion. I guess Twitter's a part of that, so that makes it different. But like SpaceX is $400 billion. XAI is half as worth as SpaceX right now. That's kind of crazy. Anthropic $100 billion. OpenAI these are huge valuations.
Yeah. It
what
is.
What are you gonna say, Brad? Sorry.
I don't really remember. I'm kind of blank. I'm kind of bummed. I forgot. Sorry, my bad.
Not bad.
I don't know. I'm just I'm very excited for the future, and maybe I'm looking too early, and maybe this is a conversation of, we're actually frothy 2.5 years from now, 3 years from now, and that these are actually the early stages, because artificial intelligence is making unbelievable productivity gains. Stablecoins will add to the velocity of money. Like all of these things are going to add to economies around the world. But I'm also just seeing that some companies are getting pumped up pretty heavily in these markets that are pre-revenue, practically 100%. Pre-idea. Like, it's unbelievable. So, there are
now several SPACs coming on market solely to buy cryptocurrency, the treasuries. I mean, there's a lot of excitement in
how do those go wrong? Listen, maybe they just don't make money. How this is stupid money on those Bitcoin treasuries. My mind tells me there's no way these are not going to go wrong at some point. Everyone thinks not everyone. Some people will tell you, hey, there's not going to be another crypto winter. I really think there probably is. I honestly wonder if there's a world where all these Bitcoin treasuries, it just becomes, they fall under NAV. Michael Saylor buys all of them, and we're back to one Bitcoin treasury.
Yeah, I mean, there's definitely going to be another crypto winter, but I just don't know if it's going to be a 90% sell-off as like what you've seen before. I definitely think that there is a base being built up, and maybe the next one is a 35% sell-off. It's just not going to be the
I think
extremes.
If you get up to 150, falling back down to 50K, that's what, a 66% fall-off?
I mean, you're saying these numbers. I'm not saying it's going to fall to 60.
Here's what I'm saying. You look at the previous cycles. You look at kind of the top of the previous one. You kind of look at the low. You want the low of this next cycle. You don't want to go below the last one. If it dipped below a little bit of the high of the previous one, that's where I expect it to go and hold. Just basic TA talk. I think that puts you around 50, 60, 70K. I don't know, maybe around there. Like, I feel like that feels pretty easy. And then, you're talking about the bull cycle after that. If it continues, 500K. I don't know. I don't want to get crazy here, but like that's what if you like kind of impose the previous cycles, that's kind of what this would do.
It is pretty exciting, at least for the fintech companies that I cover over time. Like they benefit so greatly from the not only just the coins raising, but just the speculation on them. So the fact that is talk about Bitcoin getting to 250,000, 500,000, whether you're a believer or not, does make you speculate on where companies like Robinhood, Coinbase, these sort of names could go. If that's just one piece of their, well, I mean, Coinbase is definitely heavily part of their revenue, but at least for Robinhood.
Have you seen any headlines from the Coinbase thing?
I'm watching the stream. They're showing off, from what I saw, faster speeds on Base. They're
Base
talking
is built
about
on Ethereum, right?
Yeah.
Pump my bags, guys. Let's keep that one going.
Someone actually donated to me, like, I don't know, 10 days or so ago, and said, "Hey, can you please use this money to go buy SBET?" And I'm up like 130% or something.
Did you buy Honeywell?
I did buy Honeywell.
I donated to the fund to buy some HON, $10 worth of Honeywell. You're welcome.
Yeah,
no selling that out until the second half of next year. I heard those talks. We're keeping it in there.
Yeah, I'm gonna track it, and if it does bad, we're gonna bring you to court. You're gonna have to explain yourself, but I think you'll do fine. Are there any company-specific pieces of news that you guys wanted to cover this week? Obviously, we saw the NVIDIA chip ban or unban, I guess you want to say.
Yeah.
Anything
that felt
like
pretty
that
meaningful.
That you want to talk about?
I thought that was pretty big. There was we haven't heard. I don't think we've really gotten full confirmation from the White House yet, which always scares me. But we've heard NVIDIA talk about it. Then we heard AMD come out and talk about it. And then we had, goddamn, my newsletter failed. And then we had I think there's another story, like NVIDIA wants to do more advanced chips there. So we've had one story say it, another company confirm it, and then we've had like a double down, which felt a little weird, all without hearing the White House about it. So I am cautiously optimistic, waiting for the taco, and hopefully it gives me a couple weeks. But
yeah,
I mean, do you think
there might be some short-term disruption in the company or in the stock if it does get reversed? But I wasn't even expecting.
He's there, I believe, for the next week or so in China, meeting with people. That'd be quite the wild thing if we Jensen met with Trump last week, and then you undercut him. At least let me get out of there, and then undercut him. All right, give me a week. That'd be crazy.
No, but I'd be happy with this company at 170 without the China segment that was just added. So I'm not too distraught on the idea that if they did take it away, that would be devastating. Obviously, if it does end up going through and they do end up seeing another $50 billion a year revenue stream, I'm going to be a very happy camper. But I'm in agreement with you. I'm not betting the farm on it going through 100%, but I am 95% optimistic.
I think they're about to stuff $20 billion worth of revenue in China as quickly as they can this next quarter, and then ask questions later. And this is going to get banned again. It's like, fool me once, shame on me. Fool me twice, shame on you. Or we can continue there. But we're at like 4 or 5 here. It's gonna happen again. But the hope is they can get $20-30 billion of revenue for $3-4-5 billion worth of time, cost, and effort, and everything. So we'll see. Yeah. Did you guys see? I did get a Tannor Palmer Lucky comment yesterday.
Oh yeah, I saw that. That was cool.
I didn't see this. What was this?
It was the greatest day of my life, honestly. I'm kidding, but I'm pulling it up.
I think the other, interesting event, maybe companies that people don't care as much about, but they have just such a great read on U.S. economic health and things that matter for every company we do care about. So big bank earnings, Citibank, Wells Fargo, JP Morgan, Bank of America. I won't get into really nitty-gritty credit data, but they all 4 of them said the economy is holding up surprisingly well, and soft landing and consumer spending is steady. And so all of the things that matter for consumer facing brands and really every company finding profit growth looked good. So that was good news.
Yeah. Go ahead, Evan.
Oh,
I
so
didn't think
one
it's
other
anything
thing,
valuable.
people were complaining about JP Morgan profit falling year over year. That's because they had a massive gain from Visa equity stake, and then from the First Republic bargain purchase, they had like a $3 billion gain on purchase there. So when you exclude that, I think it was like 9% profit growth. So good bank earnings for sure.
Yeah. Overall, any other comments from Jamie Dimon or JP Morgan in general that got you excited for broader economies, not just JP Morgan's stake?
They talk about stable coins quite a bit. I mean, how just basically we're not really
I heard
sure.
some language. I don't know if it was him. What was it? I have no idea what's happening here, but we can't miss it.
Exactly. It's like we don't know what this is going to be, but we're going to be part of it. And so, which I think for them, it's a very low risk, low cost, low lift way to ensure that they don't become even more of a dinosaur than they really kind of already are to a certain extent.
Well, they're huge in the payment space, and I mean globally, stablecoins will be a massive advantage, or at least the way that I understand it. So, I'm sure JP Morgan will be on top of it. I always talk about, SoFi doing well or Robinhood doing well and taking from the big banks, but in no way am I calling for the end of JP Morgan or something like this. These, especially JP Morgan, they're very special. They'll live on for a very long time, but still wishing good things for SoFi and Robinhood.
Yeah,
I
Jamie
will
Dimon is good at his job for sure.
As far as earnings, though, and earnings season, bank earnings suck. The banks are not made to make sense. There's some black boxes in there. I love my tech earnings. Just fun. We're having a good time talking about all this techie stuff. Banks are just.
I mean, the charts that I do for these earnings reviews, it's like 15 It's like 15 rows of net charge off rate, consumer net charge off rate, auto net charge off rate. I mean, it's just there are so many credit metrics, and all of them matter, and they say different things about forward looking or backward looking credit health that they are super annoying, and the balance sheets are super annoying to read. So yeah, I do love a core software balance sheet. It is underratedly easy to understand and read.
Which is a good thing, actually, just for multiples in general, is you actually don't want too hard to understand or black box type companies just for the multiples of the businesses, excluding Palantir. That one seemed to have worked out. But overall, I think easier to understand businesses usually can demand higher premiums.
Yeah. Anything else you guys want to cover, or should we wrap?
No, I have chat's talking a lot about BMNR in here.
I know nothing. Peter, is that the one Peter Thiel just bought?
He did buy some. It's the Tom Lee one. Listen, my thought process on this one is if the 2025 music is dancing, Tom Lee is the person playing the music. I might have said this last week. And if he says Ethereum, here we are up like $700 since he got behind this. What the hell? This hasn't moved in forever. I don't know. Something tells me we're not going to be talking about SBET that much longer as an Ethereum treasury company, and everyone will start to shift off this way. Now,
is that what BNMR is? That another
BMNR is it's an Ethereum treasury company. It's Tom Lee is the chairman or CEO, one of them. So Peter Thiel put 9.1% into it. Basically, it's hey, we're going to do what MicroStrategy did, but probably on an asset that doesn't have a fixed supply. So this probably isn't as good of a strategy.
Yeah,
that doesn't matter for the short term. I feel like
you're probably right.
And I have some as a trade. I told you I bought some last time and I sold it a little early at, let's say 30, 35, and I bought back in at 45, 31 is what I have right now. My cost basis. So I think
you're paying attention to the music so you know when it stops.
Yes.
Yeah,
100%.
Why do you say that? Like, this is another thing that I find with the treasury companies. Why is BMNR going to work and SBET is not?
It's not that it's going to work. Is that what is the difference between any of these? Nothing. It's maybe how much yield can you squeeze out of this fine? To me, it's the marketing. And nobody's going to be able to outmarket. Nobody on SBET's going to be able to outmarket Tom Lee and Peter Thiel. Have fun with that.
Yeah, but don't you think that there's going to be some arbitrage to just look for the treasury companies and then base them on a multiple of NAV, and then
I don't think it's going to go away necessarily. Yeah, probably for a little bit. I think, like I said, I think in a crypto winter, some of these ones fall below NAV, and maybe get acquired by a Sailor or something, the Bitcoin ones. But SPEC probably won't just go away, but I feel like when people talk about these ones, SPEC gets talked about a lot. I just think that main one that people are just going to go in and think about it and buy is probably going to be BM&R. And how long is this theme going to last? I have no idea. I don't get the differentiation. We have SPACs coming up, as you were saying. I should launch a crypto treasury SPAC. Why not?
Well, there you go, covering topics ranging from JP Morgan to the new stock market news crypto SPAC. So both ends of the risk tolerance spectrum.
I saw Chamath put out his thing, and I was like, listen, I actually got a real company that I've talked with and worked with that I could try and take public here for playing this joke game. But no, it's silly season is here. I don't know.
Yeah, it is. It's not quite like 2020, 2021. I don't think it's that stupid, but it's approaching that ballpark of stupidity for sure.
Yeah, it does look like the ball is spinning faster though. Like we're about to see some things that some rocks that get put up for auction for $70 million or something like this.
Man, that was I think the most frustrating part of the last bull. The NFT things, like they're pictures of cartoons and people are paying millions of dollars for them and telling me no, you just don't get it. It's like I wanted to pull my hair out, but I think that they maybe didn't get it the way they thought they did. And so, but now I'm sure that was a valuable learning experience, and now they own blue chip growth companies and are doing great.
Hey, if you got a bunch of celebrities that want to buy the pictures and they get talked into it, they have the disposable income. I mean,
I guess greater fool theory, right?
All right. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. If you want to, please check out the people to blow me to my right or left, depending on what it is on screen for you guys. But Brad Freeman at Stock Market Nerd on X, and Evan Stock Market News on X. I'm on X as well, but you'll find me on YouTube mainly. Anything else to say?
What's the name of your YouTube channel, Tanner?
Future Investing.
Oh, good to know.
Yeah, crazy.
How'd you come up with the name?
I like betting on the future. I think that there's been one theme my whole life that has worked out for me, is that technology deserves a multiple, and I've stuck with that. I think the world's going digital. I think it's just an easy way for me to bet on different sectors and industries that are going digital. It's worked out for me so far. But yeah, that's background on me, I guess. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. Bye-bye for now.